Hello, my name is Mark Lupo with the University of Georgia Small Business Development Center, and today we're going to be talking about securing money, which is what a lot of business owners are looking for these days. I mean, just to handle the operating cost with the economy down the way it is, additional capital is necessary. And then as we look at growing a small business, you always need more capital. So a banker told me once, he said there are four hurdles that one has to get over in order to secure a loan. And these hurdles are four kind of steps that you want to be thinking about as you are looking to go to a lender and to secure some funding. So this is what they're looking for, and this is what you want to be thinking about and looking to have an understanding of these four steps, so that when you get to the lender, you know what they're going to be asking about and expecting from you. So first thing, the first hurdle, this banker told me, was that credit score, which we all hear and know that credit score is important. So as you come to a lender, you know, in the past they've expected anywhere in the mid 600s, 650, 680 and above to really look at seriously qualifying for a loan. It doesn't mean that if you are above 700, say, that you would automatically get a loan. And on the other side, if you're below 650, 625, that you wouldn't get a loan just by virtue of having that lower credit score. But our goal is always to make it higher. And so one of the things that you want to be thinking about is the information on my credit report accurate? And the best way to do that is go to either one or preferably all three of the credit reporting agencies and secure your credit report. Not necessarily your score at this point, but your credit report, so that you can look at the report, see that all the information there is accurate. If you need to make changes or challenge certain pieces of information on there, you want to go ahead and do that before you go to the lender, and preferably a month or two out, so that those changes can have taken effect. So credit score is important. Your goal would be to get that credit score up over 700. So you get your credit report, you go through it, you make the changes, challenge what you need to, send it in, and 45 days, 60 days after that, you're at a point to where you can potentially have the most accurate credit score at that point. Once you hit that credit score hurdle, the next hurdle would be your debt to income ratio. Debt to income ratio has to do with the amount of debt that you have, those monthly revolving debt payments that are going out, and compare that to what your income is coming in. So debt to income ratio would be, it would include payments for like a home, a mortgage, potentially rent. It would have things like credit cards, auto loans, those type of revolving payments. You want to group those together monthly basis and then compare that to your income coming in. And many lenders are looking at somewhere around 25 to say 35% debt to income ratio. Some lenders will go up to 50%. So as you're kind of evaluating which lender that you may want to work with, as you go through these hurdles, you're wanting to create some sort of spreadsheet so that you can track the answers and the expectations of the various lenders in regards to these four criteria. So you're looking at credit score, what are their basic expectations related to credit score, debt to income ratio, what are those expectations. As far as the kind of certain banks, on the 50%, they might be maybe a little bit more easy to acquire a loan than, say, somebody that, or one of the lenders that has a 25% debt to income ratio. But you just have to factor all of these different elements into the final decision. So credit scores first, debt to income ratio second. The third hurdle that you're going to want to cross over is determining what the personal equity injection requirement will be for that lender. In other words, how much money do they expect you to put into the project before they put their money into the project. And in the past, this has run maybe 10% or so of the loan minimum. These days, it's 15% pretty much on the low end. going up to maybe 40% on the higher end. So you want to, as you're talking with the lender, you want to find out what percentage of the project cost do they expect you to put into the project before they loan you the money. So again, 15% up to about 40%, that can make a big difference, especially as you get up longer into the larger amounts of loans. And then the fourth criteria is collateral. How are you going to secure the money that is lent to you by the lender? And they're going to want pretty much 100% coverage of the capital that they're providing you. They want that full amount collateralized by some type of asset. Many times in the past that's been real estate, but it's not always. It could be stocks, it could be cash, it could be sometimes inventory, depending on what that inventory is, possibly build out. Some of that's a little bit harder to be accepted as collateral these days from a lender. So you have those four elements. You're looking at credit score first, second, debt to income ratio, third, personal equity injection, and fourth, collateral. And if you are able to, in your mind, answer those four questions, when you go to a lender, some of those would be the questions that you would want to be asking that lender, as in, what is your requirement for credit score? What is your requirement on a debt-to-income ratio in order to make a loan? What would be the personal equity injection requirement from your bank, say, in order to acquire a loan? And fourth, what kind of collateral do you, as a banker, provide or allow for me to submit in order for that loan to be secured? So again, those four things you want to keep in mind as you get ready for a loan. Again, this is Mark Lupo at the University of Georgia Small Business Development Center, and we look forward to helping your business grow.